The rout on global markets triggered by US recession fears and the unwinding of the yen carry trade ripped through markets overnight, although there are signs of it easing this morning. US stocks are down 2 to 3%. It's after the Nikkei fell 13.5% yesterday. The yen is surging, but the Aussie and Kiwi dollars have been caught in the downdraft of a flight to safety. They're down between 1/4 and 0.5% this morning. It's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, I spoke with ANZ's head of FX research, Mahjabeen Zaman, last night after a day of turmoil in Asian markets to find out what the earth is going on.
Clearly, across all yen crosses, we are seeing massive unwind. Dollar yen has strengthened about 12% from its high in July.
But first, in 5 and 5 with ANZ, global markets continue their rout overnight, with the S&P 500 down 2.5% at 4 a.m. Sydney-Melbourne time. The Euro Stoxx 50 was down 1.5%, and the Nikkei was down 13.5%. There are signs, though, this morning that the turmoil may be easing. The S&P 500 improved through the day. It had opened down 4.2%. Here's ANZ economist Bunzi Madhavani in London on what's driving the moves.
Markets are worried that the US economy is heading into recession and that the Fed will have to cut aggressively in coming months to support the economy. Coupled with that, there is more confidence now that the Bank of Japan will be hiking in coming months. So on the one hand, you have the Bank of Japan hiking rates. On the other hand, you have the US Fed cutting rates. And this combination came together as the perfect storm.
Number 2. Markets have increased their pricing for Fed rate cuts this year, lifting their expectations to at least one 50 basis point cut. Remember, they're normally 25 basis points. There were even reports yesterday of traders expecting an emergency rate cut by the Fed. At 4 a.m. Sydney-Melbourne time, the yield on the 2-year US Treasury was down 4 basis points, although the 10-year was flat. Here's Bunzi again.
We think the moves that we're seeing in the market are an expression of yen carry trade unwinding vigorously and its impact spilling over across asset classes. In that sense, the big moves are in response to positioning shock rather than change in economic fundamentals. Markets are currently pricing 115 basis point to 120 basis point of rate cuts from the Fed this year, which implies markets are either speculating on 50 basis point rate cut moves or intermittent rate cuts.
We'll have more on the yen carry trade in our deep dive. As of 4 a.m, the US dollar index was down 0.4% because of that surging yen. The Aussie dollar was down 0.26% at 64.92 US cents, near a low for this year. And the Kiwi down 0.47% at 59.29 US cents after a global flight to safety. Number 3. This was supposed to be the big news today, but the RBA will have to make a decision on rates later today. It's expected to hold the cash rate at 4.35%. ANZ senior economist Catherine Birch thinks the board might still discuss whether it's appropriate to hike rates before settling on no move, particularly as most other central banks start to ease.
Inflation is still running quite high in Australia at almost 4% for both the headline and the trimmed mean measure. And they have seen inflation really, or that disinflation, I guess, has really stalled in Australia. Now, we have seen that happen in other economies. In Q1 this year, we saw disinflation really stall in the US, and that disinflation has since resumed. But inflation is still running too high. So while it's not high enough to suggest that the RBA will hike at its meeting, it's still too high to expect a cut in the near term.
Number 4. The RBA is set to produce an updated set of forecasts at this meeting, which Catherine says could include a few changes from May.
While trimmed mean inflation estimates should be little changed from their May forecasts, there will likely be some material revisions to the headline CPI forecasts, given the impacts of the government policy decisions, particularly those electricity rebates. But we should also see some near-term downward revisions to GDP forecasts as well. I think importantly on inflation is we still expect that the 2026 inflation forecasts will continue to show a return to that midpoint of the target of 2 to 3% for inflation, so the 2.5% mark, which is definitely something that the RBA is looking to get back to.
Number 5. Rate cuts are on the horizon this year in Indonesia after Q2 annual GDP growth eased to 5.05% from 5.11% in the first quarter. ANZ economist Crystal Tan says final domestic demand is now running lower than its pre-pandemic level.
recent conditions have turned more conducive for a BI pivot. We look at the US Fed, it's now opened the door to a September pivot. Weak US labor market data last week has only further strengthened pace for rate cuts sooner rather than later. So the scope for Bank Indonesia to lower its policy rate has increased. We now expect at least one 25 basis point cut by BI in Q4, and the balance of risk is tilted towards more if the US Fed's easing cycle turns out to be more aggressive than we currently anticipate.
Crystal Tan there. Now, in our bonus deep dive interview, I spoke with ANZ's head of FX research, Mahjabeen Zaman, from Sydney late last night, after a day of record-breaking turmoil in Asian currency, stock and bond markets, to find out what on earth is going on. So Mahjabeen, could you give us a sense of how unusual the action on currency markets and bond markets are today?
In Asia time, we have seen heavy selling over worries around the US economic outlook. We've seen a surge in the yen and, rising interest rates in Japan, of course. And then, of course, massive deleveraging as investors are reacting to declining economic indicators, which respond to the US in terms of the jobs data and general global market instability, you could say.
Why are we seeing so much action in Japan? I mean, a 13.5% fall in the Nikkei. I see it's described as the worst since 1987, and there's been big moves in the dollar yen as well. Why Japan?
Look, I think it's a little bit of that worries around US recession coming up. That's one thing. And of course, we saw the Bank of Japan finally raise interest rates now, the market, and we are expecting another rate hike ahead in October. And I think this is being factored into the direction of the yen. And clearly, across all yen crosses, we are seeing massive unwind. Dollar yen has strengthened about 12% from its high in July. Again, yields, Fed futures are turning very dovish on Fed pricing in cuts. This has supported the yen. And then we're talking about, of course, yen interest rates moving higher. So again, that narrowing of rate differential is supporting the pair. Last but not least, of course, yen also tends to be a safe haven currency. Now, previously, in the last 2 or 3 years, in risk-off scenarios, dollar and Swiss franc would benefit in terms of safe haven currencies. Yen is the traditional one, but we haven't seen much love for the yen in the past 2 years. But now, given that it's out of that negative interest rate territory, it's also getting some safe haven flow. So again, whichever way you look at it, it's supporting yen strength in the near term.
So people are bringing money back to Japan, but they're not putting it in stocks. Are they putting it into Japanese government bonds? Because I see the yields are down sharply.
Yes, exactly. And I mean, the Nikkei or the topics, we've seen circuit breakers. And I think the reason for that is that I think it's really concerns around the exporters getting impacted from the stronger yen. And obviously a large contributor to the market are really the Japanese exporters for the equity market.
It's great. And the Aussie and Kiwi dollars, how are they coping with all of this drama?
Look, I guess risk-off tone surely doesn't help Aussie and Kiwi. We tend to be cyclical currencies. Today, we have just seen a new year-to-date low for the Aussie dollar in this whole risk-off scenario. Of course, we are looking forward to the RBA meeting today. We are, of course, expecting no change in interest rates. And, of course, what we have seen in recent domestic data or in this recent cycle, we've seen that domestic data only has short-term impact on the Aussie in either direction, but it's the global dynamics that tend to play a more prominent role in which way the Aussie moves. But having said that, just one point I'd like to mention, RBA, we don't think they're going to cut rates for a while. We're only expecting them to start cutting next year. But looks like there's a lot of pressure on the Fed to start cutting soon, and that rate differential will be positive for the Aussie.
Yeah, I see 4 cuts in the pricing from the markets. And I see some talk around of, out of schedule cut. Is that a real thing?
Look, we're not expecting an out of schedule cut. We think that it's just this momentum has just begun. Yes, there is weaker data. US economic story does look weaker. The NFP kind of spoke to that, but we need to see more data. The Fed will really need to see a little bit of more data flow before moving the needle. So we still think 25 basis points in September will be the next move for the Fed for now.
Mahjabeen Zaman there, all about the yen carry trade. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, August the 6th. Catch you tomorrow with full reaction to the RBA's decision and that ongoing turmoil in global markets. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.